A very good morning, friends. So, I hope you're all doing safe as well as healthy. Well, I have been talking of Indus 12 for a lot of videos in this particular month, and here comes another area, interesting area on Indus 12. Well, if you recall, in terms of the step number 3, we were discussing the concept of certain areas when a DTL is not recognized. The two cases, one is goodwill, and one is what we're going to discuss today. Similarly, in terms of a DTA, there is one particular exception where a DTA is not recognized, and that's what we're going to discuss today. So basically, what we're discussing today is the area of exceptions, both in terms of a DTL as well as in terms of a DTA, where the standard prohibits the recognition of a deferred tax asset as well as a deferred tax liability. Now, why does the standard tell you that it is not to be recognized? I think let's dig this further with some examples to you so we can understand the logic in terms of saying that a DTA DTL is not to be recognized in these cases. अगर आप प्लान कर रहे हैं अनअकैडमी पर किसी भी सीए एग्जामिनेशंस की कैटेगरी को लेके अपनी सब्सक्रिप्शन, चाहे वो फाउंडेशन के लिए हो या सीए इंटरमीडिएट के लिए हो या सीए फाइनल ग्रुप 1 या फिर सीए फाइनल ग्रुप 2 के लिए हो, इस वक्त आप अवेल कर सकते हैं 20% डिस्काउंट ऑन ऑल सीए सब्सक्रिप्शंस। लेकिन ये ऑफर आपकी 27 से लेके 30 जून तक की है और इसके लिए आप मेरा कोड इस्तेमाल कर सकते हैं CAKB10। लगाएंगे 10 लेकिन मिलेगा आपको 20% डिस्काउंट। तो 30 जून को रात 12 बजे से पहले यानी कि 11:59 PM से पहले, हालांकि इतना लंबा इंतज़ार क्यों करना है, यदि आप प्लानिंग कर रहे हैं तो उससे पहले ही, लेकिन लास्ट डेट इसकी 30 जून है। तो कोड इस्तेमाल कीजिए CAKB10 और 20% इसके अंदर सब्सक्रिप्शंस पर ऑफ पाइए। आपको डिस्क्रिप्शन के अंदर लिंक मिलेगा डिस्क्रिप्शन बॉक्स में, जिसमें सीए फाइनल ग्रुप 1 और ग्रुप 2 के आपको डायरेक्ट लिंक्स मिलेंगे और आप इसके अंदर सब्सक्रिप्शन ले सकते हैं। तो भाई किस बात का इंतज़ार कर रहे हैं, आइए लेट्स correct it. Before I take these examples with you, I've taken 2 examples, but I think before I take the examples, I think let's understand some very fundamental input in relation to deferred tax. One is, if you record an income and expense in accounting in a particular year, and you record that income and expense in taxation also in the same year, that means there is no dispute between the two. You're recording an income and expense in accounting in that year, and the same income and expense is getting recorded in the same year in taxation, so that does not result in any difference, or we can say it would not lead to any deferred tax consequences. Imagine a second situation where you are saying that this particular item is recorded as an income and expense in this year, but for taxation it's an income and expense not this year but maybe a later year. Or it could be vice versa. That means it is getting recorded in the 2 books, but it's getting recorded at 2 different years. In accounting in a different year, in taxation in a different year. So this would lead to a dispute, this would lead to a difference, and we can say deferred tax consequences would arise. So typically, one would land up thinking that if the income and expense is recorded in both accounts and tax, then there is no difference, no deferred tax. If it is getting recorded in the 2 books but in different years, then there could be a deferred tax implication. Now imagine a third situation where we are saying that you are recording an income and expense in accounting, but you're not going to record it in tax. Now, if that's not going to be recorded in tax, then we can say it becomes more like a permanent difference, because the difference which is arising in a particular year is not going to get reversed in a later year. That's more like looking at from an income statement point of view. So I think the logic is very clear that if you say that it's get recorded in both books in the same year, no deferred tax. If you say it's going to be recorded in 2 different years, deferred tax. And if you say it gets recorded in one book but it doesn't get recorded in the other, then it makes a logical sense that there should be no deferred tax recording, because it's more like a permanent difference. So the standard doesn't use the word permanent difference as such, but I think the exceptions is indicating the essence that this is supposed to be a permanent difference. Let's look at two examples on this area. Let's imagine that we purchased an imported car for 100 lakhs. Now let's consider that for depreciation, let's say consider for tax purposes, no depreciation is allowed. And on sale disposal, there will be no capital gains or losses. Nothing is going to be taxable. Nothing is going to be deductible. So basically, no income tax implications as far as the profit loss on sale is concerned, as far as the depreciation is concerned. It is quite indicative that this is a case where if you record a depreciation in accounting, it doesn't get recorded in tax. If you record a profit loss in accounting, it doesn't get recorded in tax. So this would indirectly mean it's a permanent difference. But I think let's apply our concepts in terms of calculating a carrying amount, a tax base, and let's see the balance sheet approach. Now, if I consider the carrying amount of the asset at the time of initial recognition, it is supposed to be 100 lakhs. And if you consider a tax base, naturally the asset is definitely going to give you economic benefits, because when you're going to use this car for the purposes of businesses, then naturally it is going to give you economic benefits, and those economic benefits will be taxable as well. But the income tax authorities will not allow you any deduction in the form of depreciation or against those economic benefits. So the tax base of the asset being a future deduction becomes zero. So the carrying amount is 100 and the tax base is supposed to be nil. You get a taxable temporary difference of 100 lakh. So let's say the tax is 30%, you are getting a DTL, but it is illogical to recognize this DTL, because the differences which is going to arise due to depreciation or profit or loss on sale will get recorded in one books, but it's not going to be ever recorded in the other books. So it doesn't make sense that we record such a DTL. So the standard makes a prohibition that if due to initial recognition of any asset or liability which is not on account of a business combination, and at the same time it doesn't affect the accounting or the taxable profit at the time of initial recognition, then it is illogical to recognize such a deferred tax implication. So this is one example on a DDL. Let's I think have a look at another example which will give you some insights on a DDA. Now let's imagine that we are getting a government grant. So let's say the government gives you a grant which is tax-free. Now one can easily see that a government grant from accounting point of view is going to be slowly credited to the P&L year by year, because you're going to put this in the deferred income today and you're going to give a credit to the income statement over a period of time. But if you look at from the taxation point of view, being tax-free, it's never ever going to be recorded in the taxation books. So there is an income to be taken in one books and it's never going to be taken in the other books. So that means it's again a permanent difference. But let's apply a balance sheet approach. If you look at the carrying amount of this liability, because the moment you receive the grant, you're going to put this in the deferred income account and you're going to say the carrying amount of the liability is 100. Now let's apply the tax base of the liability definition. Now when you look at the tax base of the liability in this case, I would say first of all, it's a situation like income received in advance. If it is an income received in advance, then in this particular case, we can say, in this particular case, the tax base is the carrying amount minus the income on which there will be no tax in the future. So 100 lakhs is the amount which is the carrying amount, and 100 lakhs is also the amount on which there will be no tax in the future. So 100 minus 100 becomes nil. Now the carrying amount of the liability is greater compared to the tax base of the liability, resulting in a deductible temporary differences, and in the taxes at the rate of 30%, you're getting a DTA. But then it is again illogical to recognize this DTA in the books of accounts. As we said, it's going to be recorded in one books, but it's not going to be recorded in another books. So the differences which is originating in a particular year is never ever going to get reversed over a period of time. So indirectly we can say that these are examples which are permanent differences in nature, though the standard does not use the term per se as a permanent difference, but I think it is quite indicative that when we are looking at non-recognition, or I would say the prohibition in terms of recording these deferred tax asset and liability, it's a clear-cut case of a permanent difference. That's all in this particular video. More interesting things coming on this particular standard. So wait for more such videos on this in the coming month. Thank you for watching. Bye bye and take care.